Hey folks, I want to share some information about options management for retirement accounts. I'll explain it and then show you a demonstration. Start with an overview. So, option contracts can be used to leverage your assets. That's your stocks and your cash in your investment accounts. I show you two options transactions that are very conservative and safe. So, while options are commonly used to speculate or gamble, these two transactions are leveraging your assets, they're not speculating. And with just a few minutes per week or month, you can greatly increase your account growth and performance. So, option contracts can be executed in self directed accounts only. You cannot execute options on managed or custodial accounts. For example, a current 401k or an RRSP managed by your company, but any accounts outside of that can be self directed. In the US, those are things like IRAs, Roth IRAs, brokerage accounts, and in Canada, tax-free savings accounts, and then self-directed RRSPs and LIRAs, and of course, brokerage accounts. Some basics. An option is a contract that represents an agreement to buy or sell shares at a specific price with an expiry date of that agreement. Buying an option gives you the right but not obligation to buy or sell the stocks at a specific price. To do that, you have to pay a premium if you want to buy an option. However, selling an option gives you the obligation to buy or sell the stocks at a specific price. With that, you will receive a premium for this contract, cash. Two types of options, calls and puts. So think of calls as contracts above the current stock price and puts as contracts below the current stock price. Tracking management. So it's important to keep track of what option orders you've entered. And it's easy to do that if you use a spreadsheet, and I can give you a template. Covered calls. Again, for stocks that you own in a self-directed account. An order to sell a call means that you will agree to sell your stocks if they reach a certain price, call it a strike price, within the contract period. You will receive a premium for this agreement. It's also called a covered call. Option contracts are in multiples of 100 shares of stock. So one contract equals 100 shares. If it does not reach that price, the contract will expire and you can place another covered call. So you're going to select your shares or ETFs that you do not mind selling. I recommend you use Yahoo Finance to view prices. There, review the stock chart for trends and pick a desired price that you would sell at. You're going to pick an expiry date in the future, and I recommend 1 month or so for calls. Consider dividends. So if they occur during your desired contract, generally avoid options trades during that period. Also, if there's any unusual events such as earnings or stock splits, you might want to avoid selling a call. Also, consider, of course, your purchase cost of that stock and ask yourself, what are you really willing to sell it for? Secured puts. These are option contracts backed up by cash in your account. In order to sell a put means that you will agree to buy stocks if they reach a certain price, also known as a strike price, within the contract period. You will receive a cash premium for this agreement, of course, that you get to keep. It's also known as a secured put. Again, option contracts are multiple of 100 shares of stock. You must have cash in your account to purchase the stocks if it does come down to the defined price. If it does not reach the price, the contract will expire and you can place another secured put. So you're going to want to choose stocks that you do want to own. If you end up having to buy the stocks, you'll be happy either way. Yahoo Finance to view prices, review the stock chart for trends, and pick a price that you would be happy to pay for the stock. Select stocks or ETFs that you would not mind owning. And pick an expiry date in the future. For puts, I recommend 1 to 2 weeks. Also consider dividends if they'll occur during the desired contract, and any unusual events such as earning dates or stock splits that can introduce volatility, which you don't want. Now let's do some demonstrations. Let's look at a spreadsheet I use to track my options. This first tab essentially gives me the information I need to know about a stock. I've got my ticker, the account that it's associated with, the number of shares, the current cost, what I paid for them, the book cost, the dividend dates. I don't want to be doing options transactions on dividend dates or included in dividend dates because the price becomes quite volatile. But I see my dividends expected per quarter, and here I have a strategy for that stock. In this example, sell a far covered call, which means I like this stock, I want to keep it. I don't want to let it go. So the cover call I'll make is going to be quite a distance from the current cost, so there's less chance of it being assigned and sold. This is a stock I don't currently own, NVIDIA, with Ally Bank. My strategy here is a purchase secured put, so 100 shares, current cost $116, I don't own it, but here's the dividend dates and the dividend. So that way I've got my base information for my stocks. This tab, the options tab, shows me the actual transactions I have. Let's go from the bottom up. Qualcomm, date opened on October 2nd. The expiration date for the contract is 27th of October. I sold a call. The stock price was $109.81 at the time of transaction. 7 days until our contract expires as of today. The current price is $109. The strike price I entered was $116. So this means I agreed to sell 5 contracts, that's 500 stocks, at $116 before October 27th. For that, I received a premium of $1.18 per contract, per share rather. My fees from my brokerage account were $3.32. I got an immediate cash payment of $586. Here I see the difference so I can track where I stand. I have $7.01. The stock has to go up $7.01 before that contract would be sold. These other two are similar. There's another call where I agreed to sell 100 shares, Qualcomm again, in a different account, for $117. And that was done when the stock price was $111. I got a $1.59 contract on that, times 100 shares, less the fees, $157 I got for that transaction. The top one is a put, so I agreed to purchase 100 shares of Qualcomm for $107. For that, I received a premium of $1.02, my fees $1.01, and my cash I received was $100.99. Here, the current price is $108.99. So only if that stock, this one actually executed and expired out of the money, so that contract is days to expire was 0. So it is complete. Now let's look at Yahoo Finance. So bad day going on right now. Dropped pretty fast. But in yahoofinance.com, I'm going to search for Qualcomm, QCOM. This gives me my summary. So some of the key items I'm looking for, obviously, there's the price. I am seeing that I've got a 2.88% dividend on this stock. My ex-dividend date is November 29th. So on November 29th, again, the dividend will be paid out. This is a summary chart. Typically, I'm going to want to look at 1 month. 1 month showing me very choppy up and down, but no real trend. 6 months, similar. There was a peak. It really is quite a flat stock. I can go into full screen here and see a lot more information. Now yours will not appear exactly like that. You'll see the top box. But this is showing me the daily. This is set for 3 months currently. I could change it to 6 months. It's showing me the price levels, confirming what the previous screen showed. And then I have these other indicators that show me RSI, relative strength indicator. So between 20 and 80, if a stock is below 20, it means it's oversold and the price is likely going to go up. If it's above 80, it's overbought and the price is likely to go down. So it's consistently in this band, which is great. What I see, however, it's what's called stock is consolidating. You see these bands, these are Bollinger Bands, which is the standard deviation, 2 standard deviations of price over a period of time. I think it was over 30 days. So if I zoom in, just scroll in here, it's a little hard to read, but you see the lower end, the Bollinger Band around 108, upper end 113, 112. So it's pretty tight band. So again, it's not going to move that much. So to me, this is a safe stock. It's not going to move around too much. And if I go back and have a look at my Qualcomm, so here, for instance, I've got 500 in this account. I should go to the other side. In my E-Trade account, I've got 500 contracts. So let's say this is expired and I'm looking to do it again. I need to determine what my strike price is going to be. In that case, in this transaction, I did it for 116. So going back, I'm seeing that very stable pricing. Now, if I go back, I want to show you, first of all, how to look up the dividend information. In this screen under historical data, and if you change it from historical prices to dividends only, it shows you the dates, the dividends, and these are ex-dividend dates. So that's where I get my information to add to the other spreadsheet. 80 cents dividend, 75 cents. So you can anticipate the next one is going to be November 30th and are close to it, and here is actually November 29th. Good information. Another tab here, very important, is the options tab. So first thing to bring your attention to, again, remember it's $109, is the term. Some stocks have monthly contract terms, others have weekly, some even go to daily, high volume ones. The next available option contract is October 20th. So that is, it's now, no, it's today. So I'm going to move it out to October 27th, next Friday. And this is, the first section is for calls. Again, this is for stocks that you own. The current price is 109. So let's say I chose to sell a call for 114. It means I agree to sell my shares. If the price goes up to $114, I will get, the last transaction that was executed is 55 cents per contract, which represents $55. If I agreed to sell it at $111, I would get $168 for that contract. When the order is entered, we have, again, this column is last price, the last transacted price. There's a bid and ask, so it moves around minute by minute. On the right-hand side, you see the open interest and volume. So these are the number of contracts that are active or on the market. So it's not huge, but there is quite a bit of activity with Qualcomm, and it's a good stock for options trading. So that's the call side. If I scroll further down, you'll see the put information. So puts. So let's say we're looking to buy stocks here. So we would sell a put. Again, current price it's just bumped up to 110. The blue means it's higher. So which means if I'm going to buy stocks, I want to buy it at lower than the current price, right? If I entered a contract to buy 100 shares of Qualcomm at $107, the last transacted price on that was $1.13, $113. So again, that contract transaction would, in the next element of the video, I'll show you that transaction. Let's look at an example of a secured put transaction. Here I'm on E-Trade. Every platform is different, but they will essentially do the same thing. In this example, I'm going to go to trading options. I've got my account. I'm going to enter my symbol, QCOM. It tells me the last price, live price. I am going to execute a put transaction. I'm going to sell to open. So it's very important to sell to open. Quantity of 100 shares for next Friday. I can change that, but next Friday. The strike price. So we looked at it previously and we said strike price was going to be 107. So I changed this to 107. And it is set to put, so it can be put or call. $1.19 is the current bid price. So I am going to enter a limit order. You don't ever want to do a market order for options. The limit price, I'm going to use the same price that's active. The bid. This is the minimum amount I want for this order. And how long my order is going to be open for. It's good for today. That's all you want. It's going to tell me what my estimated proceeds are and the commission. Then if I hit preview order, yeah, in this example, I'm already committed to all my funds, so I get this error, which is good. But if I had the funds uncommitted and available to use, then I'm just going to hit execute the order. Then the order will, of course, either be filled or not filled. It may fill at higher, so it may fill at $1.20, and then get more money for it, but it will not fill at lower than $1.19. Now let's switch it over and show you what a call would look like, how to enter a call. So a call is an agreement to sell stocks. So if you have these stocks, of course you have to have these stocks, you own these stocks in your account. A call, and you're also going to sell to open. You're going to choose your expiration date and the price that you're willing to sell it for. So let's, in this case, choose $1.12, 112 rather. It's a call, 95 cents. It's a limit order, 0.95. Good for the day, and that's it. I hit preview order and execute, and that order again will go to the market, and it'll either fill at a higher price, I'll get more money for it, or it won't fill. And if it doesn't fill by the end of the day, it expires and it's null and void. There's two examples of how to enter call and put orders. Happy trading.